डॉक्टर बाबासाहेब आंबेडकर ओपन यूनिवर्सिटी.
Hello friends, once again welcome all of you for the course of Fundamental of Financial Accounting. In the last module, we discussed about the difference between the bookkeeping and accountancy. So what is the basic difference between the bookkeeping and accountancy, that we were discussed, as well as we discussed the branches of accounting and the different kind of accounting methods. So as we understood that what is financial accounting, what is cost accounting, what is management accounting, what is tax accounting, social responsibility, and etc. and etc. So this is what all about we discussed in the last module. In current module, we are going to discuss about the classification of accounts as well as the golden rules of accounts. So how the accounts has been classified and what are the rules and regulations of those accounts. Here the important part of that, because of, as we discussed in the previous modules, that some monetary transaction has to be identified in each economic transactions, and after the identification of the economic value of each transaction, it has to be recorded in the books of accounts. So that we were actually already discussed. So we understood that those economic transactions are there, which is necessary to record in the books of accounts. So now here we identified that once the economic transaction has been identified, we need to identify that which account has been impacted on this economic transaction. So this is all about the classification of accounts. So now here in this unit, this module, we are going to discuss first the classification of accounts, and then after the classifications, each classified item has a certain rules and regulations. Moving to this part, the takeaway of this module is the classification of accounts, as there are three major accounts are there. One is personal account, then the real account, and the nominal accounts. It has been classified in these three classification, and then there is each classification has their golden rules also, like debit and credit, which account has been debited on the certain time, and as well as on the credit also. So there are certain rules when it will be debited as well as the credited. So now moving to this part, let's identify how that has been classified. Here, the broadly, as per the understanding and conventional approach, the accounts has been classified into two major parts. One is the personal accounts and the second is an impersonal account. Personal accounts, it is understood that as per the person who is live, or maybe the person who has been actually recognized by the legal entity or a legal representation. So that personal account can be divided in this way. Or an impersonal account, it means that maybe it is considered as a part of a real account or maybe a nominal account. So here that amount of distribution can be broadly, maybe when you are going to identify the person has brought the capital in the business. So when he brought the capital in the business, the person is brought the capital in the business. So it is considered as a person. But what he brought into the business, cash, or maybe machineries, or maybe land, or maybe building, or certain things. So the land, building, it is considered as an impersonal, and the person who brought in the business is considered a person. So here in those ways, we just need to divide the personal and impersonal. Here, we just need to identify the personal account means the person who brought the capital in the business. Suppose, in case of the person brought the capital in the business and the business has a certain name, maybe XYZ or an ABC or enterprise or XYZ enterprise or and so, then again, the ABC enterprise or an XYZ enterprise is actually giving a name by a legal representation. So in that way, the ABC enterprise or an XYZ enterprise is also considered as a person. So now this is called a personal account. Real account means the account which are actually having a certain values, certain properties, certain assets, certain block things which has been actually represent the business for a longer period. So this is called the real account. The real, it means the assets which are actually carried by the entity for a longer period, it's considered a real account. And the third is the nominal account, means the any kind of activities which are actually done in the business regularly, to run a business smoothly, which is considered a nominal account. So the expenses or an incomes or the transactions which takes place regularly to run a business smoothly, it is represent of a nominal account. Now here, that the personal, real and nominal accounts, these three classifications forms on the basis of applying the certain debit and credit items, and then debit and credit it has a certain rules also. So as I already discussed that the accounts are three, but it might, as I already mentioned an example, that the person brought the capital in the business. Who brought the capital in the business? The person. Maybe myself is actually brought the capital in the business. So I brought the capital in the business in the form of cash. So what comes in? The cash comes in. So cash is actually debit. So that is the logic which needs to apply here for debit and credit. I just have to more examples to discuss with you, and then you will able to understand how these all things are going to do it. Let's move first account, that is personal account. How this personal account is actually works and how the things is moving further. Personal account is first we need to identify the who is personal, right? Here the person is actually considered as a natural and artificial. The natural, it means the person who lives, that means the person. Like natural person refers to the human beings, like me, like you, like any kind of the person who live, right? The person like Manoj, or maybe a Parag, or maybe a Kunal, or maybe XYZ, any kind of the person who is represent himself to doing an activity lively, considered as a person. Artificial persons can be maybe the person who actually represents of the any kind of enterprises, or maybe a company, or maybe a firms, or maybe a banks, or maybe a institutions, or maybe a insurance company, or any persons who is actually giving an entity by the force of a law. So that's called that artificial person. So one is a natural person, other one is an artificial person. Natural is a live person, and artificial person is actually giving an existence the force of law, by the force of law. So here the personal account is actually that further has been divided, but here there are three bifurcation of the personal account. One is the person is natural person, as already we discussed, the person, the human beings who are actually doing all activities lively, considered as a person, or the person who takes actions by themselves with their minds and with their opinion is considered the live person. That is a person account, right? Here that we need to understand artificial person. Artificial person, as again we are discussing earlier, like that the any enterprises, any bank name like a Bank of Baroda, State Bank of India, Life Insurance Corporation of India, or maybe any entities like a Tata Enterprises, or Tata Steel and Iron Limited, or maybe a Tata Consultancy Services Limited, or Reliance Industries Limited. Like these are the company which are actually giving their name and the representation on the basis of a law, by the force of law. So this is called an artificial person. And one more is a representation of accounts. That is again consider of the personal account. Representation is like what? I have an outstanding income from the certain people. So representation that the income has been receivables from the XYZ, that is the representation, it is called a representative account. I have to pay to the someone, that means I am actually having an outstanding amount and paying amount to the third party or to the XYZ, it is again considered as a representative account. So that means that any kind of an outstanding liability or an outstanding income, or maybe the payable amount or receivable amounts, it's considered here the representative account. So these are the three basic broader case in the personal account. Now, after this personal account, we need to understand the golden rules of the personal account. How it works actually? Very simple way. The golden rules of the personal account, it consider the debit the receiver, and credit the giver. It means that the person who receives his account is debited. We'll take an example also. Like here, I just want to tell you the rupees 5,000 given to Bank of Baroda, or 5,000 rupees deposited in a Bank of Baroda. So who is receiver? Bank of Baroda is a receiver. So Bank of Baroda's account is debited. As the Bank of Baroda is also a person, I know that it is an artificial person, but already we discussed that there are three kind of person. One is the natural person, and then the artificial, and then the representation. Here, the Bank of Baroda is an artificial person, but who is a receiver? Bank of Baroda is a receiver, so that's why the Bank of Baroda's account debited. Here, so that's why the Bank of Baroda account is debited. Credit portion we will discuss later on, because of here it is we are discussing only a personal account, right? So the credit we will discuss later on. Now credit the giver. Credit the giver. I'll take another example to explain the credit the giver. Suppose the 5,000 rupees given by Manoj to XYZ. Here the XYZ is a receiver, because of the XYZ is receiving this 5,000 rupees. Who is a giver? Manoj is a giver. But Manoj is writing an accounts. So in case of the Manoj is a giver, so XYZ account debited to Manoj account. So giver is Manoj. Ultimately, the who is a giver? Manoj is a giver. So that's why the Manoj account is credited. So here we need to identify who is a receiver and who is a giver. So very simple way, that the amount is received or received by the someone, the account has to be debited, and the amount has been given by the someone, his account would be credited. Another examples which we can take it, that's very simple way. Now the 5,000 rupees loan taken from the Bank of Baroda. So here the cash is received, but that is not a personal account. So we will just not consider right now. We are not going to discuss it. But who is a giver? Bank of Baroda is a giver. It is given by the Bank of Baroda and in the form of a loan. So the Bank of Baroda's loan account is credited. So because of the Bank of Baroda is giver and they are giving in the form of loan, so that's why the Bank of Baroda's loan account is credited. So this is the golden rule of the personal account. Now here, the example is also discussing here, rupees paid 5,000 rupees to Sayal. Here the debit is Sayal. Why? Because of 5,000 rupees offered to Sayal. Sayal is receiver, and that's why the 5,000 rupees Sayal's account debited. What goes out, it's a secondary thing, because of it's not a personal account. But anyway, the cash goes out, so the cash account is credited. The cash is actually a real account that we will discuss in the next slide. So this is the part of an example. Who is a receiver? Sayal is a receiver. That's why the Sayal's account is debited. Now, impersonal account, that is real and the nominal. Real account, as already discussed, that any kind of an assets which are actually useful to generate the business or to generate the revenue in the business, it's considered a real, which is actually exist in the business for a long period and which helps to the owner as well as the business to generate the revenue. So this is what the real account. Here all the assets are actually considered as a real account. Now here all accounts, these are actually non-personal, it's considered a impersonal account. So those are actually not a personal account, it's considered an impersonal account. Like any kind of assets, it's actually a real account. And then the losses and any part of incomes, expenses, all are actually considered under the impersonal accounts. It is broadly divided into a real as well as the nominal, right? Here first we are going to discuss the real account. Now, the real account, it's considered as a part of the assets. Assets is actually having two parts. One is the physical assets that we are going to discuss first. Cash, it's a physical assets. We can touch it as well as we can see it also. Then the building, then the land, machinery, plant, furniture, vehicles, etc. and etc. All these assets which we can actually feel also, which we can actually touch also, and which we can see also. So now all these assets are actually available, existing in the business, as well as it is considered as a physical assets. Now these are the tangible assets. There are two more bifurcation in this assets. It's one is tangible assets and other is an intangible assets, as it was already discussed in earlier modules also, if you are aware about it, tangible and intangible assets. But these are the tangible assets because of it is actually you can easily touch and you can see also. That's why it is considered as a tangible assets. Now the another is a non-physical assets. That means those assets which are actually not visible, but it is not visible, but you cannot touch also. It is just a part of a feeling that there is some assets which are actually carried with the business, which creates the valuation of the business, like a goodwill, like a patent, copyright, trademark. So these are the actually assets, but it is non-physical assets. But all are actually assets and considered under the real account. Now, here physical and non-physical assets, but it's a real account. How it works and the golden rules for this assets. Now moving to that part. So here the golden rules for the real accounts are debit what comes in, credit what goes out. It means any assets. Now here we are going to represent in the form of an entity or a form of the business, right? Whether it's a sole proprietorship or maybe more than one person having a partnership, or maybe the enterprise, maybe a private limited or a limited in any kind. The rules are remain same for that. So what comes in, it's a debit. What goes out, it's a credit. So here if you are going to take the example from your point of view, from your side, suppose I'm starting my business and I brought machinery in the business. So in the business, what comes in? Machinery comes in. So machinery account is debit. In your point of view also, if you are going to do a business and you think about it, you purchase a land and land comes in. So what comes in? Land comes in. So land is debit. So any assets comes in the business, it's debit. Any assets which you start your business, it comes in the business to start your business, that's why it's debit. And any assets which goes out, it's considered as a credit. Suppose if you purchase a land to pay a rupees 5 lakh, what comes in? Land comes in. So land is debit. But you pay 5 lakh rupees to purchase a land. So what goes out? Cash goes out. So ultimately assets real, it goes out. The rules apply here. The cash goes out, so cash is credit. So this is the way these rules are applying in the real account. Very simple way. We'll take some examples also in this case. See the example, purchase furniture for rupees 50,000 cash. Here the furniture you purchase, and for that you paid a cash also. So what comes in when you purchase furniture? So furniture comes in. So that's why the furniture account is debited. And you paid cash against the purchase of furniture. So what goes out? So cash goes out. So that's why the cash account is credited. Very simple. So here just you have to apply your logic. The first is when you are seeing the transaction, you need to identify that the which account is applied in this transaction, whether it's a personal account or a real account or a nominal account. It might that when you are actually doing some entries, when you are actually explain the transactions and bifurcate the transactions, then you will get some answers out of it, and then the transactions will be evaluated. You will find out there are two statements. One is personal account and other one is the real account. So in that sense, I already gave you an example in earlier when I was explaining a personal account, that 5,000 rupees cash brought by the owner in the business. So what comes in? Cash comes in. So that's why the cash account is debited. Who brought this cash in the business? Owner. The owner brought cash in the business. So owner is personal account. So ultimately owner's capital account is credit. So here that you need to one by one, when I'm actually explaining another account, I'm taking transactions together so you can understand better way. So that's why I take it here that now here the furniture is debit and cash goes out, cash is credit. So this is the way the real account is actually applied. The key principles which you are actually have to keep it in your mind, that real account track the flow of assets in and out of the business. The rule focuses on movement of a property, not on the who is giving or receiving, but on what is entering and leaving the business. Ultimately, when you are applying the rules of real account, you have to apply it instead of your the logic that who purchase and who sell is not important. What is actually comes in the business and what is going out from the business, that is more important. And then only you can apply the rules, and then you will actually get the proper answer to apply your rules for the real account. I think you must be understand, and I think you must be understand two combined entry of the transactions when the personal and real are also attached. Moving to the next part, now it is nominal account. It is also a part of an impersonal account. So some assets we already discussed, which are real account. Now nominal account, the account which are actually applied for those transactions which are running for run business smoothly, or maybe the transactions which are takes place to run your business very genuinely or smoothly. Here the some regular expenses and incomes which are takes place here in the business for regular transactions, and that is actually takes place in your business. So these are the nominal account. Let's move to identify which are actually the part of your nominal account. Here the nominal accounts have actually no physical existence. Why it is no physical existence? Because of ultimately it's maybe an income, or maybe an expenditures, or maybe a gains, or maybe a losses, and it has been actually understood as a part of your revenue as well as your expenses account. Correct. So there are so many type of any expenses, or so many times of any your incomes also. Now in that, all these incomes and expenses are directly affected to the your profit and loss, because of ultimately all these businessmen are doing their business for earning a profit and loss. To earn some profits and loss, they are doing such kind of transactions, and that those transactions which are might be expenses, or for certain expenses they occurred the expenses to earn a revenue also, to earn income also. So all this way actually they identified incomes and expenses. Here all these incomes and expenses are considered as a nominal account. Now I just will identify what kind of expenses and losses. Maybe any salary to be paid to employee, it's considered as a nominal account. Any paid rent for factory or for offices, consider as a nominal account. Any kind of depreciation, any kind of wages, any kind of advertisement expenses, any kind of commissions, any kind of octroi, taxes for the routine octroi, or any kind of GST taxes, all these expenses to be considered as a part of your expenses and losses. Then any incomes and gains, you might having some amount of investments, and then you received an interest. Maybe you have some shares, then you received a dividend. Maybe you received some commission because of you are doing some brokerage business, or maybe you are receiving some discounts. So these are the incomes, right? So expenses and incomes you identified. Now it is very simple way to apply the rules and regulations for nominal account. How it is considered? All the kind of expenses and losses are debited. So the golden rules for that, all the expenses, all the losses are considered debit, and all the incomes and gains are considered credit. So very simple way, the debit all the expenses and credit all incomes. Very simple. The transactions which takes place here, the 5,000 rupees interest received. Very simple. What you received? Interest. Maybe you received interest in the form of cash, or maybe the interest received on your behalf, the bank is received. In case of you received cash, then affect the real account. Correct? So cash comes in, cash account debit. In case of the bank is received your interest, who is a receiver? Bank is a receiver, that the bank account is debited. What you received? Interest you received. So the nominal account is applied here. Interest is your income. That's why the interest account is credited. Any kind of expenses you paid. Suppose you paid a salary to employee. So what you paid? Salary. Salary is an expense. So salary account is debited. You paid in cash. Cash goes out. The cash applied real account. What goes out? Cash goes out, so the cash account is credited. Suppose if you paid any salary through bank, then the bank is a giver. Because of you paid salary through bank, so your bank account paid salary to the employee's account, your bank account is giver, so bank is giver, bank account is credited. So in those, this is the way to apply the debit and credit rules for the nominal account. So all the general entries is actually applied here. This is the way all the three golden rules applied in the different kind of transactions. But here, the transactions which are actually merged, maybe when you are evaluating a transactions, it happens, it is affected with personal account and real account together. Maybe sometime personal account and nominal account is together. Sometimes it happens that all the three accounts, personal, real, and nominal, also together in one transaction, in each transaction. So when you are understanding the transactions, when you are explaining the transactions to yourself to identify which accounts affect this transaction, you have to analyze it first. Then after the analysis of the transaction, you have to apply the rules and regulations. And after the application of the rules and regulations, then you need to understand which account is debit and credit. This is the first part. Then might be another part of a segment is it happens that sometimes the debit amount is different than the credit amount. Sometimes that's 3-4 items were actually debited and the total amount of the debit item would be credited by the single account. Like I'll give you another example. Honor brought 5,000 rupees plant, 5,000 rupees furniture, 5,000 rupees of vehicle brought into the business. So there are 3 items brought into the business. One is plant, then the furniture, and then the vehicle. So all these 3 assets comes in the business. As per the real account, all 3 assets comes in the business, that plant, then the furniture, and the vehicle. All these 3 accounts are debited. All these 3 brought by the owner. So owner brought in the business. Who is a giver? Owner is a giver. In this sense, the owner brought these all things in the business. The capital account is credit. So the furniture account debit, machinery account debit or a plant account debit, then the vehicle account debit, 5,000 each. But capital account credit, 15,000. So as I mentioned, there are 3 account debit, 5,000 rupees each. But when you are going to credit, the capital account is credit by 15,000. So it happens. So sometimes the debit amount by the 3-4 items or maybe more items, but the credit amount will be only a single account will be credited. So on all the economic transactions has to be evaluated properly, then necessary to divide into the different transactions. Then each transactions has to be identified which are the accounts affected to that particular transactions. After the bifurcation of that, then we need to apply their rules and regulations. As per the rules and regulations, we need to identify which account will be debit and which account will be credit. And also that amount, along with the amount, we need to identify whether the debit amount and credit amount is matched or not. Because of it's always twofold effect. As earlier module, we understand that the dual effect. What was the dual effect? The dual effect, it means that the amount which is debited, the same amount has to be credited. Not in a single transaction, but in total, it has to be matched with the debit amount. So the debit and credit has to be matched. So this is the way to the transaction has to take place. The summary of this that again all these what we discuss in this module, we discussed that there are 3 accounts. One is personal account, then the real account, and the nominal account. These are the classification. What are the rules and regulation for that? Personal account is debit the receiver, credit the giver. Real account, it's considered debit what comes in, credit what goes out. And in case of a nominal account, the all expenses and losses are debit and all gains and profits are credit. So this is the way the units were discussed in this particular lecture. I hope you would be understand properly, and when you applied all your this with your practical exercise, I think you would be getting all the knowledge. Hope so you will understand better. We'll meet you soon in the next unit. Thank you so much.